Welcome, everybody, to the Chinchilla Pickin' Podcast. As always, we like to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and as always, I'm here with Brandon Beaver. Brandon, how are you doing, man?
Oh, man, the Bengals are in the Super Bowl.
The Bengals are in the city. See, if anyone's listening, we live in Cincinnati, Ohio, in the United States, and the Cincinnati Bengals are in the Super Bowl. So, I mean, I don't always cheer for the Bengals, but I'll give a hooday for them right now.
I don't always cheer for them either. I'm a Cowboys fan. I'm cheering for them on Sunday night, mostly because this is a city that is not used to having a championship team in the past 30 years. So,
the winner, right?
Yeah, it makes me happy to see it.
Yeah, me as well. And you got the Olympics going on as well. I mean, a lot of sports happening right now for us over here. We got Nick Gepper from Cincinnati competing on Sunday.
Dave, is snowboarding really a sport?
Yes.
I'm stabbing at you right now on purpose.
Yes.
They do some crazy stuff, and you have to be super athletic to be able to snowboard and do it right. I agree with you. I was just messing with you.
Right. I mean, if you follow our Instagram, you notice I've put on a few pounds over the last couple of years, and I have not snowboarded in the last couple of years. I do have a plan to lose all that weight, though, so maybe next season I'll be back on the board.
I've put on some.
We'll see.
That was mostly from the 3 months of not working, but
that happens, man. That happens.
Yep.
Anyways, people came to hear us talk about stocks and investments, not about snowboarding.
What are those?
Yeah, what is that? Who knows? Let's go over the rules. Brandon and I get together before the show, about 5-10 minutes before the show, and we tell each other what we're going to talk about. You have the live discussion right here for you. And it's going to be a nice one because Brandon and I were telling each other what we're going to talk about, and we completely disagree. So this is going to be a fun one today.
I don't know that you completely. I haven't made all my points, so you may not completely disagree with this.
Well, listen. You know what? Let's have everybody hear this out. I'll let you go first. You start down the road here about the yields, and I'll jump in and raise my hand when I need to. I'm just kidding. I'm glad we're recording this though, just for so I could say, hey, here's where you were wrong. No, I'm just kidding.
We can go back to it. By all means, if I'm wrong, call me out in a year from now. I don't think I will be.
All right.
Okay. So we've talked about this on the show before. Since July of 2020, the Fed has been buying at least $80 billion a month of treasuries and $40 billion a month of mortgage-backed securities. For many reasons, this has propped up the stock market. Now, the goal was to lower yields and make borrowing cheaper. That's what they did, and that's why the stock market got propped up. The Fed is not going to stop purchasing these things altogether, but they're tapering. They're trying to avoid disrupting financial markets. That usually doesn't happen. Actually, it usually does disrupt financial markets. We saw it in 2016 and in 2013. Taper tantrums is what they called it. And bonds, which are dead to me. People generally move out of longer dated securities so they don't get stuck with low interest rates over the course of a long term. As we've talked about on the show before, many financial companies borrow short term and lend on the longer end of the yield curve. So this would provide a boost to those financials as longer term interest rates would rise faster than short term interest rates. However, that's not what's happening so far. Short term interest rates for now seem to be rising faster than long term interest rates. This is why I just took an 11% profit on AIG, even though I think their financials show that generally they would be an undervalued stock right now. I see it now, it's entering value trap territory. We've had that 11% gain. Let's take it. I'm thinking that the reason why the short-term rates are rising faster than the long-term rates, investors might be seeing inflation on the rise in the short term, but they're leaving short-dated bonds as a result. That's why the short-dated interest rates are rising faster, because they're actually getting out of short-dated bonds. It could be that investors and money managers see inflation running hot for the short to medium term, but they see it cooling down over the long haul, which could be good news, but it may very well be bad news. This is where we're trying to juggle, like, what the signs here of the market are, they're kind of confusing at the moment. The yield curve between the 7 and 10-year treasuries is currently flat and it's starting to invert. This is something to keep an eye on, because if investors start to see inflation running hot for the short to medium term, but they're buying into the long dated bonds, they could see deflation coming on the way. And if you have hot inflation, then deflation, then what you're often going to have is a recession. So this could be very well bond traders and investors seeing a recession on the horizon.
I don't see deflation happening, even with the perfect scenario you're talking about.
Well, it's not perfect.
And
It's a terrible scenario, but yeah,
right.
I know.
But it's just because of the current spending policies and practices that are going in place, and the fact that the government is still buying bonds and mortgages. They said they're going to taper. They've set dates for tapering, but they have not yet started tapering. So we are still spending $120 billion a month buying these.
That might even be worse, because instead of seeing like a 2008 recession, I don't want to say that it's going to be that bad. I don't have a crystal ball in front of me, but instead of seeing a normal recession where a bull market ends and you've had hot inflation going into it and we kind of hit a wall and we crash, and then you have deflation after that, we could have 1970s style stagflation, where we're trapped in a recession with high inflation and you have to pick which one to battle. And that's even worse for stocks. I mean, the 1970s for stock markets, by and by large, was a lost decade. And I would prefer to see a recession on the horizon that brings about deflation, even though that means a lot of pain in the short term. That also means that in the long term, we can get back to normal.
It wouldn't be a lost decade today, and that's just because of all the derivatives. I can make money on the market going down.
You could, for sure.
So I mean, it's not going to be lost nowadays. There's going to be people still making money and being profitable, given that scenario. And with inflation at 7.5%, the highest inflation we've had in this country since 1982, I sure hope it's eventually going to wind down, like you're saying. What's your timeline on that, though?
You know what? You can't really have a timeline on it.
So
I think
1 to 2 more years of this, the economy cannot handle that.
Yeah, I don't know.
You're going to crush the middle class and the lower class.
There have been so many people who have pulled out that crystal ball and tried to call a recession or tried to call another bull market, and the crystal ball costs more to me than my reputation does. So,
right? I mean, but here, my point,
can't do it. If I'm reading like, some of this people that you see on CNBC that have been in the market for 4 years or 40 years, I mean, and they can't exactly decipher when the next recession is going to be, then I can't. So I don't want to do that. But I will say that probably in the next couple of years, I tend to see the Federal Reserve tapering and hiking interest rates as being a signal of the end of a bull market.
Gotcha. And I agree with you on that. And I agree with you that everything's going to lead to a recession. We just disagree on how we get there. But I believe it's because a lot of it has to do with inflation. When people are getting paid more, yes, you're getting, a few more dollars more to work at McDonald's or some of these other places now, where so I've seen signs at McDonald's for $20 an hour starting off, right?
Right. That'll come down.
I mean, well, it's not only going to come down, but like, you were getting some people were getting 5% raises, 6% raises. Well, now you have 7.5% inflation. Your raise is gone.
Yep.
You're back to losing money again. And I know a lot of people that I have worked with in the past, they average about 4% raises a year in raises, and now it's gone. And it's just it's going to hurt the lower to middle class. And if they start having to make choices between food and going out, you're going to see them not go out as much, not participate in discretionary income activities. And then you're going to see that affect other areas, because if people can't go to baseball games, baseball stadiums aren't going to hire as many people to work those stadiums.
Right.
And it's the snowball effect.
And then imagine being retired on a fixed income.
Oh, you're hurting right now. You're hurting.
Yeah, you're gonna have to go out and get a part-time job. It's sad.
It's almost $10 for a pound of beef now.
Yeah. I am watching the yield curves though. Just getting back onto that.
Yeah, go ahead. Back to the
The
yield.
7
Sorry.
and 10 year doesn't matter as much, which is why the market's not depressed right now over it. I mean, the NASDAQ is down like 12%, but we're not in a serious depression over the 7 and 10 year. What you really want to be watching are the spreads on the 2 and 10 year, and then the 10 and 10 and 30. And if those start to invert, then that's a problem. Like I said, that generally means that investors see inflation followed by deflation. You may not agree with it, and I'm kind of half and half on it because it could go either way. A natural business cycle would be inflation, then followed by deflation. With that being said, there's been a lot of tampering, obviously, by the government, and usually if you see a recession with inflation, that means that something has messed the system up severely. And there's been a lot of government spending. There's been a lot of synthetically low interest rates, and we have had those things. So do we hit a brick wall and then have a new price discovery where things come down, or do we have sustained inflation that we have to fight with continually lower or raising interest rates and trying to battle that? That is a longer term problem to have than a shorter medium term recession for sure.
I don't believe most prices come down. I believe these prices are now built in and set. The consumers are just going to have to get used to that. These are the prices now. Unfortunately, I disagree with that. Personally, I don't like it. That's what I meant by disagree. But I don't like it. But unfortunately, like even if the suppliers of let's just use beef, right? Let's go back to that example. Are now not having these extra cost surpluses, they're not gonna go ahead and lower prices. They're just gonna take that extra profit because the consumer's used to this now new price.
So what do we do about this in the markets? Continuing flattening of the yield curve, that'll make a lot of investors start to take defensive positions. That would be high dividend paying stocks with current earnings that are really good, and stocks that don't have as much of a risk of cutting those dividends. You generally see utilities and consumer staples outperform in this scenario, but we have high inflation, and utilities often have legislation that limits the amount of price increases that they can have over a year. So utilities, I think, is a bad bet, but most utilities, not all, but I wouldn't be in any water companies or electric companies or anything like that. I prefer consumer staples right now to be defensive, and consumer staples, hopefully you can get a good dividend on something. On the other hand, if you have an increasing yield curve, if we start to see it unflatten and go higher, that would favor financials, banks, and insurance companies. So it's something to keep an eye on. The yield curve will fluctuate from day to day and week to week, but you want to watch the trend and see which way it's going. Right now, it looks like it's starting to flatten, which does not favor financials. And that's why you haven't seen financials take off over the past month. Now, you had financials at the end of the last year start to rise, but over the past month, they've been stagnant, and mostly it's because of that yield curve flattening. The fact that the Fed is tapering and hiking rates likely a lot this year, it makes this a very difficult year to invest in, especially for beginners. If you're going to be the type of person that's going to buy a stock like Apple on a big dip and just add to that, then that's fine. I still like Apple even in an inflationary environment. With that being said, a lot of investors that begin in the market are buying penny stocks. They're buying the GameStops. They're buying that's not a penny stock right now, but you get where I'm going. The very, very highly speculative stocks that people are getting into and trying to get rich in the next 2 to 3 years. And those are not the kind of stocks that you want to be getting into. Dave, go ahead.
All right, so
let me just make one more point. I'm sorry. New investors.
Go ahead. Make another point. Go
often
ahead.
do not have the patience and the risk tolerance to last through big dips. That's another reason why I'm telling you investors to not get involved in the stock market right now. Go ahead.
Gotcha. All right. I disagree.
Okay.
I completely disagree. I don't believe there's ever a bad time for a new investor to get into the market. I just don't.
2007, 1999, not
2007. You in 2007, it took 1 year and your money came right back. It was a nice big giant V that lasted a year, and then you started making profit. All right. So, all right.
I'll let you finish.
Here's the thing. Like, if you're a new investor, I want you guys to DM us, right? DM me. I'll walk you through what to do. You start with paper trades. You do your paper trades. You see how well you do. If you don't know what a paper trade, maybe I'll write an article on this. I'll write an article on this. You start with paper trading for a little bit. You follow that for a few weeks. Then you start doing not all of your money at first. You want to go just a little bit in and go start with just 30% in. See how well you're actually doing with real money, real trades. Find out if you're a day trader, swing trader, or an investment type person. What type of personality you are. What type of sectors do you understand? Like, do you understand how a grocery store makes money? And maybe that's the sector you get into. Or do you understand how banks make their money? And by understanding, I mean how the news that's happening in the world would affect that company, right? How, when they release an earnings report, can you read it and understand for that type of business? Do you understand how they make money and how they're profitable? That's your sector you start in. That's the one you start in and you grow, and you watch it and you watch it and you watch it and you watch it daily until you start figuring out, okay, I've done these paper trades. I'm 8 out of 10 right. I'm going to go ahead and start putting a little bit of my money on the board here. And it doesn't matter because, like I said earlier, with so many derivatives nowadays, Brandon, whether the market's going down or up, you can make money.
You can,
I can
but
short,
the
I can
derivatives
call.
are even tougher for new investors to understand.
Yeah, but you don't even have to do a derivative. You could sell it. You could short it. You could short the stock.
You could, but that's also like if most people would be buying puts, which are options and derivative as a result.
They'll be buying puts and calls because they're not listening. They're not listening to you and I. We're here to guide you.
Yeah, that's true.
We would say buy the stock or sell the stock at first. Don't start in options until you have some experience under your belt. So what you're going to do, you're going to sell this. You're going to buy the short. You're going to short the stock, or you're going to buy it. It's going to be one or the other, but you can make money either way. And I don't believe there's a bad time for anyone to start investing.
I think it's a tougher time. Let's put it that way. It's for sure a tougher time.
But that's why we created Chinchilla Picking.
Yes.
We created this to help people. And so if someone's out there and someone is out there and they're new, we can help them. We can guide them. DM us, reach out to us, email Brandon Beaver at chinchillapicking.com. He checks that email daily. I know he does. I mean, Brandon, I'm just saying, man, there's never a bad time for someone to start investing. You just got to take the right steps and do it the right way.
You do. That's true.
And then you will succeed.
Yeah. Yeah. So 75% in general, 75% of new investors lose their money in 1 year.
And why is that though?
That's not
why is that
in 2020, but we're returning to the mean for sure this year. And that's because they invest in the wrong things. They don't learn how to read balance sheets. They don't learn how to read all the financial statements that come out. They don't learn how to trade. They don't learn if they're in options. They don't learn the Greeks. They don't learn stuff like that. They need to take time to learn it. And I think this year is a good time to just settle down and learn, listen to our podcast. Even turn on, I mean, I rag on CNBC a lot because, when they have on Friday, the Dow was down 500 points. So the sky was raining blood, on CNBC, and it was the end of the world. And of course, usually when you have a down year like this year might be, that creates opportunities for the long haul. Correct. But the problem is that those opportunities, they're not going to be in the GameStops and the BlackBerries. They're going to be in the good companies that already have earnings that are being beaten down unfairly. And you have to learn, you have to figure out what companies those are and be able to decipher, what the best kind of investment is. So a lot of people are going to get into the market this year and they're going to lose money and they're going to say the stock market's for fools. It's not for me.
Right. And hold up. Here's the thing. Like 10 years ago, I told you that's what most new investors do.
Yeah.
Over a decade ago, I said that to you. I said, you're going to get in. I'm going to show you how to do a couple trades and get you going. And you're going to do a few good trades with me. And then you feel like, all right, I got this. I don't need Dave anymore. and you quit listening to people like me, and you go off on your own, and all of a sudden you do a few options, you feel really great about yourself, and then you lose all your money, and then you blame the market. And it's not the market, it's that you quit listening to the advice that got you those first couple trades. You quit taking it slow and doing it right.
And also you're out left to your own devices, and different people have different risk tolerances. You have to figure out what your risk tolerance is, what your patience level is, and you develop strategies based on that. And that's what's going to work best for each individual person. I watch CNBC, not necessarily for their investment advice, but I want to become in tune with the market and see what the mood of the market is of the day. And you can either trade with it, or you can be a contrarian like I often am, and trade against it and be prepared for the next mood swing.
I 100% agree. That's exactly why I watch CNBC as well.
Yeah.
100% agree on that. On that point. Yeah. Yeah. It's 100% agree. And you know, and the thing why people jump into and they start listening to Wall Street Bets or these others, and what they're trying to do is they're trying to go ahead and they're trying to chase the dragon or chase a stock. Yeah. You know, they're trying to force a win because they see other people win, right? They see ABC stock, right? It starts moving up. It's up 50%. People are blowing it up all over social media, and they're like, "Oh, this is the one to buy, right? This is the one to buy, right?" So then they go ahead and buy in, and then the stock drops 30%.
Right.
And then they blame the market, they blame the economy, and they blame everybody but themselves, and you know, not buying when it's up 50%. That's what we call, guys, when a stock jumps up a large percentage in one day, we call that it gapped up. And it can gap up or it can gap down. When we say hey, that just gapped up, I'm going to wait for a dip down. Yeah. That's because when the stock usually gaps up a lot in one day, or even in like a week, typically there's a pullback at some point. It's profit takers. People are taking a profit off the table, or people realize this shouldn't be valued this high. It deserved maybe a 10% bounce, not a 20% bounce, stuff like that. And so it readjusts, and you look for the readjustment. You know, you got to quit chasing this dragon, this roller coaster. And, you know, it's not a good practice to buy stocks when they've gapped up, or, you know, it's just not, it's not something you want to do.
Like you said. And you know what, we've been through, you know, I'm not insulting when I say this, but a lot of new investors are getting their recommendations from TikTok and Reddit. Dave, me and your generation, we saw investors get their advice from chain mails and AOL chat rooms. And so we've been through, you know, something similar to this before. And then once you get more experience, you start to realize, wait a minute, I should be listening to Warren Buffett and Benjamin Graham and Howard Marks, and not some random person I see on YouTube or TikTok.
Right.
That's only going to lead you oftentimes down the wrong path, and down a path to going to zero on your portfolio. 86%. I read this on CNBC that 86% of last year's new investors plan to put more money in their investments this year. My problem with that is that a lot of people see GameStop as an investment. And I'm not just singling out GameStop, but look at all of the meme trading craziness that happened last year. And you're starting to see those decline right now. And they're just piling more money into it because they think that stocks do nothing but go up over the long term. And that is not true. You can look at the S&P 500 and say over the past 30, 50 years or whatever, that's done, you know, mostly nothing but go up over the long term. But that's because these indexes rebalance and rebalance and rebalance when they need to rebalance towards different stocks. You know, we've seen Apple and Netflix and the FANG companies be oversized in the S&P 500. Probably in 5 to 10 years from now, it might be different companies that are oversized in the S&P 500, which is why that continues to go up. And over the long haul, SPY could be a great investment. I think right now it's probably not a good idea to buy in at this point in time, but if you've got a long enough horizon buying SPY, 10 to 20 years, you're probably going to make money on it, right? But individual stocks is completely different. Go ahead.
Yeah, and actually, this is one of the points we agree upon. I want to read this article. I have it pulled up here on my screen, and this proves the point, right? Here's the headline: Marketplace suspends most NFT sales, citing rampant fakes and plagiarism. All right, so I have this article pulled up here, Brandon, and I want to read the headline here. And it says Marketplaces spends most NFT sales citing rampant fakes and plagiarisms. And it really focuses on the site that sold Jack Dorsey's first tweet for 2.9 million, right? So all the Reuters and all the quotes here, it's really crazy. It says here's a quote is there's a spectrum of activity that is happening and basically shouldn't be happening. What they're seeing is three main problems. People are selling unauthorized copies of other NFTs. People are making NFTs of content which does not belong to them. And people are selling sets of NFTs which resemble a security. So even security fraud can now be one amongst the charges here that go out. And this is a headline that just popped up Friday. So what does this have to do with what we were just talking about, right? NFT was a new way to invest in online ventures last year. It blew up. Everybody on Twitter, all these people on TikTok and Twitter and Instagram or what have you were talking about, oh, NFT this, NFT that, get your NFTs here. You see I'm surprised I don't see a guy on the corner selling NFTs out of one of those little huts or something. It's just it's crazy that everybody's pushing these NFTs, and now it comes out that like there's just rampant and filled with plagiarism and fakes, and people are selling NFTs that look like securities, which again, that's security fraud, guys. You're going to get in trouble for that, and you're going to possibly go to jail. Don't do that. But now they're having to pause on a majority of these sales because they can't prove what's right, what's not right, what's real, what's not real. And it just goes to show you that a lot of people who invested money now because they pause are going to be out that money. So if you had money and if you made money and you were at the beginning of this and you sold your NFT and you made like $1 million, good for you. You made it. You did it. Great job. You found a new sector of the economy and you made your money, great for you. But if you were stuck in it right now, you may be stuck in it and you may be out. You may be out all of your money, not 100% loss. We're not talking the 60% loss. It could be 100% loss.
When the dollar starts to devalue as it did in 2020, then people start looking for ways to beat inflation. They'll start piling their money into things that even seem goofy to some of us to try to make money. They start chasing the dragon like you were talking about.
Yep, exactly it.
People start to realize, wait a minute, these things aren't as valuable as we've given them credit for, and then they start to sell them and take all the profits. And then if you're at the other end of that where you're not profitable, then that's a problem, for sure.
And then the market gets flooded with people selling and nobody buying. And now the price comes down to what you can sell it for, and people lose money if you're able to unload it off your hands. And this is the basics, and this has happened so fast from beginning to end, and we're here to end part of it. That it's a micro organism, whatever study of a basic business, that's taught in high schools even nowadays. Principle. It's a basic business principle that's taught in high school, but it's just happens so fast that you can actually view it in less than 1 year, calendar year's worth of time.
Yep.
And that's crazy. It's crazy.
We've talked about our favorite books. I'm telling new investors just to take the time to educate themselves. Don't jump right in. It's, jumping right in during the COVID crash was easy. That was an easy thing to do. But I'm going to make a prediction, and I realize this is hard to track here.
Here you go, prediction.
But I think that 90% of all investors by the end of the year will have lost money.
No, I don't say 90%. It's too high.
90.
All right. February 12th, 2022 at 5:40 p.m. Here comes Brandon's Beavers prediction.
We'll try to figure out a way to track that. I know it's going to be very hard to do, but I think it'll be 90.
I think it'll be less because if people will start listening to us and be happy with just 5% a week, you'll be doing very well.
75. I think 5% even for a medium term investor is going to be tough to do.
Dude, all right. So here, I'll give you an example. Last week on this podcast, I said, look at oil. They're going up right now. They just moved up. I would wait for a drop down. Oil dropped down on Monday and Tuesday. I personally bought in. Oil went back up. The news of the inventories, the news of Russia and Ukraine, everything happened just like I said it would. Oil went back up. I made money. I sold all in less than a week, buddy. Look at all the stocks. They're all about the same. Schlumberger, ExxonMobil. I don't think Apache did it. Rig did it. Look at their charts. They look exactly alike, all of them.
Well, look at Lockheed.
For the 1 week, the 1 week chart.
Lockheed Martin's made 17% in the past 3 months because
right. I mean, and this is what we're talking about, Brandon. There is never a day where 100% of all stock. Well, there has been in the past, but I can't see it happening anymore. But there's never a day where 100% of all stocks are going down.
That's true.
And if they all are, then you should have, made a put or shorted the stock.
You've been preaching commodities like oil for the past, 6 months, and that's gone up.
And I've been watching them. And with this Russia Ukraine, if come Monday, if we're still in the stalemate, it's going to creep up. But look for that dip down before you buy in. And on Monday. If Russia has already made a move before Monday morning open, oil stocks will soar. 5 to 10%
after
jump.
The Olympics, I think that China is going to go back to being China again. So it's going to be even more geopolitical concerns there.
It is, and I'm just trying to make money off of it right now because I don't have an army and I can't do anything about this, unfortunately. And I could just, say my prayers, but the way to make money off it, like you said, Lockheed Martin, Raytheon. I'm looking at oil stocks, but I'm looking for a dip before I get back in again, just like I did this past week. That's what I'm going to be doing next week. It's all the same calls. It's Rig, it's Schlumberger, it's ExxonMobil, ConocoPhillips, Apache. Take a look at them all. Again, I haven't heard Jim Cramer come back on his call of Callon Petroleum, but I said it was no good, and it hasn't moved. It's actually gone negative since then. Even though Cramer called it and I said Cramer's wrong. I enjoy this. I'm going to rub that in again. But look at these stocks. That's what I'm looking at as far as a way to trade this to make some money off of it. You know what I mean?
Yeah. And I bought Lockheed Martin about 20% ago. So for me, it's an investment. I don't know. I think you could probably find better opportunities if you're not in Lockheed Martin right now. To buy something at a lower price. I'm holding LMT Lockheed Martin because I did get in it at a good price, and I think you can trade it on geopolitical concerns right now. But we're starting to hit the upper band of the resistance level on Lockheed Martin. So you either wait for it to break out of that, or you wait for it to come back down again.
So what about commodities? Because like you mentioned, in times of geopolitical unrest like this, commodities will sometimes go higher. And it's a good way to trade. So, we're not going to go out and buy gold on the commodity market, right? The average Joe, but, should we buy the miners?
The miners have had a good run. I was just looking at one of the ETFs for gold miners, and that's been on a good run right now. I think I'd hold off. Once you actually start to see inflation go higher, then people start to take their profits on gold. It's prior to inflation, and if you see a fast spike in inflation like we did last week, then gold goes higher. But if people are starting to take their profits on it, then you kind of sit and wait on it. You know what I mean?
Gotcha.
It's oftentimes right before inflation jumps or during the jump, not after.
So you're basically saying, people sell the news, they buy ahead of time.
Right. Now, I'm not generally a commodities trader. You're actually way more experienced at that than I am. That's just my 2 cents on it.
Gotcha. All right, and then that's what I asked, Yeah. I understood the thing there. All right, guys, I want to go over one thing. Brandon, actually,
one more thing. Gold often doesn't respond very positively to gradual rises in inflation. So if we see like 7.6% CPI report like next month, or 7.7%, it may not go up with that, but it's the big jumps that gold responds to.
Gotcha. The big jumps.
Mm-hmm.
Or if, I mean, I bring this up just because I was around there and I started watching the market this time was 9/11. Something like that happens, gold will skyrocket and the markets will crash.
Mm-hmm.
We don't ever want to see that again. But you worry about what can happen with Russia and Ukraine, and I can't do anything about it. I might as well shore up my family's finances and actually make some good investments off of it.
Right. And that's why I hold Lockheed Martin. It's not because I want war. I'm anti-war.
Yeah.
But it's because I also don't want to go broke. So it's a hedge against the rest of the securities in my portfolio.
Yep.
All
right. If we have 1 minute, and then I'll give you the last few minutes here. But 1 minute, real quick, guys. If you have a Fidelity account and you go onto the desktop view, guys, a Fidelity account, you go on a desktop view. If you click onto news and research, if you hover over that, you could go down to where it says markets and sectors, right? So this is the Fidelity on the desktop view. You go on to markets and sectors. If you look on the left, there's a link that says U.S. Economic Calendar. And this is a tool that I use all the time. The U.S. Economic Calendar lets me know what's coming up as far as economic news in the markets. And I use it to really see if I have an investment such as oil, I know every Wednesday there's going to be the oil crude inventories number, and I could get reported here. So if I'm not there on watching CNBC, Bloomberg, or Fox Business, or on these other business channels, Cheddar News is another one. But if I'm not watching any of these business channels, I could go on this site. I could look at the economic calendar. I could click on which news I want to look at and get the full detailed report. And that's a good way I want to share with everybody of how another tool to use to research. Go ahead, Brandon.
Good one. I also like Thinkorswim from TD Ameritrade. Both their desktop and their mobile apps are great. You can paper trade with them. And
they let you do paper trades like actual real, like a real trade.
Yeah. So you can create an account with no money in it and do a paper trade in it. Actually, I have both. I have a paper trading account and I have a regular account. I don't really paper trade anymore.
Which one do you do? I was about to say, which one do you do better with? do you like throw it all in on the paper trade one and then you're conservative on your other one?
Yeah. Sometimes I used to. I don't do it anymore. I don't paper trade anymore because I don't feel the need to. But you know what? Late 1960s. Warren Buffett wrote a letter where I think it was like a fund that he had, and he actually discontinued it because he said that there was no reason to be in stocks anymore. So at that point, there was no reason to be in stocks. He wound up being right with the 1970 stagflation. So I do think that there's bad times to invest and to be new to the market.
Yeah,
we have a lot of new innovations and stuff in the market right now that make it possible to make money on the downside or on the upside, either way. So it's a little different right now. But I do want to I do think that right now as a new investor, it's much tougher this year than it was last year or the year before even. And I also want to put this warning out there. Go back and listen to the episode titled Ringing the Alarm Bells on Robinhood, because they just reported another quarter and it did not get any better. They're starting to pile up shareholder lawsuits. I do not recommend buying the dip on the stock, as I do not recommend buying anything that could go to zero. So if you haven't already, sell your stock if you own this company and transfer your money out into another brokerage. If we have a financial recession, I think this will probably be one of the first chips to fall.
All right, so a lot of people are transferring out of Robinhood going to Webull. Will Webull also fall? Aren't they set up the same way?
Yeah, you know what? They probably are, but they're not a public company, so I haven't seen their financials. So I don't know. I mean, I would assume it would be the same thing, but you know what? You go into a TD Ameritrade, people that have, a brokerage that has more 401ks and, or Fidelity, like you were just talking about, different ways to bring in money other than just newbie traders. I just was talking about how I think that 90% of all investors will finish the year with losses. I also think that 75% of new investors will lose all of their money. And what does Robinhood make their money off of? New investors.
Yep.
Yeah. and often, and a very large chunk of it was off of options, which is even worse.
Yeah. Yeah, because options can kill you.
Yeah.
My long-term investments, I'm still holding them all: Nvidia, Intel, and Cooler. I will give a shout out to my daughter. I keep her name quiet for anonymity's sake, but she did make a trade 100% on her own. No advice from dad. Dad did not help out. She made 10%. She went ahead and she bought Blink when it dropped all the way down to $18 a share. She actually made over 10%.
Nice.
And then as Biden announced that they were going to give a big chunk of money that was already been passed through Senate and the House, they announced that they were going to give a big chunk of that to Blink Charging to build more EV chargers in the United States. And thus Blink Charging went from 18 to 24, $25 a share because of that news. And so she had a great trade. Very proud of her. Good job. As I wish I did that well last week, but unfortunately, I'm gonna have to take my 3 to 4% that I made and be happy with it. I'm still long on Nvidia. I think that's a good company. Even in worst case scenarios, it might dip down lower. I'm just gonna lower my cost basis.
You know what? Everybody thinks that semiconductors are still cyclical, and I think they're going to be called out on that in the next year by the market, in maybe 2 years. I don't know.
Well, but it's because AMD was.
Eventually, the market's going to catch on to the fact that semiconductors are no longer cyclical, and they are a large part of our future.
It's a large part of everything we do in every aspect we do. AMD was the biggest volume traded stock on Friday, and it was negative, and that's why people have a negative view on it. But I mean, guys, long term, you need these companies. You need what they produce to live your daily life. Doing this show right now, I probably have 3 devices I'm using that all have chips in them of some sort. So it's forget about it. No, 4. Sorry, my wireless mouse here probably has a chip of one of these companies as well.
So here's the thing. These companies are going to get punishment, first of all, because there's a lot of high multiples in the area. But second of all, people still think they're cyclical. And everybody wants to go into consumer staples right now because they want to be defensive against the crazy market and the 4 to 7 Fed interest rate hikes. However, if you get good value on these companies, go ahead and buy them, because they're not cyclical anymore. They are consumer staples. People just don't know it yet. Somehow they don't know it yet. I don't know how they don't know it yet, but they don't know it yet. I'm long right now, Procter & Gamble. I'm long Lockheed Martin. I'm long Meta still. And I still say that, this year may be tough still for Meta, but I think you just accumulate it for the future. I'm still long General Electric, and I'm still long Berkshire. You will have to pry Berkshire from my cold, dead hands, Dave. I don't think I'm ever going to get rid of it. And then there's another stock that, for legal reasons, I can no longer talk about.
And we've talked about what happens when Warren Buffett and Munger leave Berkshire. That you still think that there's very strong, successful people in place.
Oh, for sure.
To lead that company after they're gone. So Brandon is 100% behind Berkshire.
Whoever
buy it, guys. Add positions. Buy it.
Yeah, whoever talked Warren Buffett into buying Apple, 10 years ago, along with Amazon. I don't know who it was, but it wasn't Buffett that was doing that. He has even said it in interviews that he had younger people advise him on tech companies. So,
yep, he's taking advice and help from other people. So there you go, and he's doing very well with it.
Mm-hmm.
Right. Well, that's all I got, man. Guys, if you're a new trader, listen to the show, DM us. We'll be happy to help you. Seriously, send us a direct message. Email BrandonBeaver@chinchillapicking.com. He checks that every day. I'll go ahead and see if I could get an article out about how to raise funds if you're starting off and you're having a tough time. Some of the tactics that I've recommended to other people in the past, because I firmly believe if you do it yourselves, you're going to work harder for it and it's going to grow better for it. So I always try to help people do it themselves rather than just hand out. All right. Well, I hope you've enjoyed the show. We hope we've been entertaining, educational, uplifting, because we want everyone to make money. Have a good night.
Good night.